All right, picture this for a second. You have an absolutely incredible business idea. You've done the late night research, you've scoped out the market, and you know for a fact that customers are going to love it. You are literally ready to launch. But there's just one glaring problem. Your wallet, it's completely empty. Just moths flying out when you open it. You literally do not have the cash to actually start.
It's the classic dilemma almost every small business founder faces, right? And today, in this explainer, we're going to figure out exactly how they solve it. You've got the passion, you've got the idea, but where on earth does the money actually come from? I mean, if you don't just happen to have a giant vault of cash sitting in your basement, how do you get this thing off the ground?
Well, this is exactly where business financing steps in. To put it simply, business financing is just the process of getting the money you need to buy equipment, rent office space, hire employees, purchase your inventory, and, just keep your daily operations running. Think of it like the essential fuel for your company. Without enough of this fuel in the tank, even the most brilliant, world-changing ideas might just never see the light of day. Every single business, no matter the size, needs money to function.
So, here is our roadmap for today's explainer. We'll start with the business funding fuel. Then we'll tackle the big showdown of debt versus equity financing. After that, we'll look at some alternative sources of funding. And finally, how to choose your perfect path.
All right, Section 1, the business funding fuel. Why exactly is a brand new business so incredibly hungry for cash on day one?
To really wrap our heads around this, let's bring this down to earth and meet Sarah. Sarah has a dream. She wants to open a small, independent coffee shop right in her neighborhood. She's got the perfect vibe, the best recipes, and a killer location in mind. But before she can sell even a single cup of coffee to a paying customer, she has this massive mountain to climb.
Because honestly, it is wild how fast these startup costs add up. Just to get the doors open, Sarah has to secure a lease. She needs those super expensive commercial-grade espresso machines, cozy furniture, the actual raw ingredients like coffee beans and milk, plus employee salaries so she isn't literally working 24/7. Oh, and marketing so people actually know she exists. All told, these costs could easily hit tens of thousands of dollars right out of the gate. And since Sarah doesn't have massive personal savings to cover all of this, she absolutely needs financing. This huge upfront hurdle is exactly why small business financing exists in the first place.
Moving right along to Section 2, debt versus equity financing. The two main paths. So when small businesses need money, they're usually looking at a massive fork in the road, and these two paths are completely different beasts. On one side, we have debt financing. This is pretty straightforward. It basically just means borrowing money, usually from a bank or a private lender. You take a lump sum, let's say 50 grand for Sarah's coffee machines, and you promise to pay it back over time with interest. On the flip side, we have equity financing. Instead of borrowing money, a business actually sells a piece of the company to investors. These investors give you the capital you need up front, but in exchange, they now own a percentage of your business. It really boils down to some pretty strict trade-offs. With debt financing, the huge win is that you keep full ownership. You're the boss, 100%. The catch? You have to make those repayments every single month, even if business is painfully slow. But once that loan is gone, you keep all the profits. Now flip that over to equity financing. You give up a slice of ownership so you're not the sole boss anymore, but the massive relief here is that there's no monthly loan payment hanging over your head. If the company fails, you don't owe the investors in the same way you'd owe a bank. But if you knock it out of the park and succeed, you're sharing those profits with your investors forever. It's a really tough strategic choice.
All right, Section 3, alternative sources of funding. Let's take the scenic route. Because let's be real, a lot of small businesses don't just waltz into a major corporate bank or pitch to big-shot investors on day one. There are some other really popular avenues here. First up, personal savings. Surprisingly, this is how a vast majority of small businesses actually get started. It's risky for sure, but it keeps things simple. Then you've got family and friends. Super common for early startups. Borrowing from Uncle Bob to buy that first batch of inventory. Third, government grants. Some governments actually give out funding if you meet certain criteria, and the absolute best part, you usually don't have to pay grants back. Fourth is crowdfunding. This is brilliant. It's where thousands of everyday people chip in small amounts of money online to support an idea they love. And lastly, specialized business investors. These folks bring not just cash, but invaluable advice and crucial industry connections to the table.
And that brings us to our final section, choosing your perfect path. How do businesses actually make this choice?
Remember, there's no magic one-size-fits-all answer here. Finding the right fit means founders have to ask themselves some pretty brutal questions, like how much money is actually needed? If it's a few thousand, maybe family is the way to go. If it's millions, you're definitely looking at equity. Next, how fast do you need it? Bank loans can sometimes take forever to process. Do you want to keep total ownership? If yes, equity is completely off the table. Can your business reliably handle a monthly loan payment? If your sales are super unpredictable, taking on debt can be really dangerous. And finally, what's your personal comfort level with financial risk? Balancing all of these factors, that is the real art of small business financing.
And what's actually kind of fascinating is how a business's funding source usually evolves and scales right alongside the company itself. It happens in steps. Step 1. Small startups usually begin small, relying on personal savings or family to just get the doors open. Step 2. Once they're established and have some steady money coming in, growing businesses might pivot to bank loans to buy more equipment or, say, open a second location. And Step 3. If they turn into fast-growing, highly scalable companies, they'll very often attract professional business investors to pour in capital and take things nationwide or even global. The funding literally grows as the business grows.
So, if there's one major takeaway from this whole explainer, it's that small business financing is about way more than just randomly borrowing cash. It's about making highly strategic choices to manage your risk while fueling your growth. Whether you go with a bank loan, equity investors, your own piggy bank, or a viral crowdfunding campaign, building a successful company from the ground up completely depends on making smart financial decisions. Understanding these options, it's really the very first step toward building a lasting company.
Which brings us to the end. We've seen how absolutely vital this funding fuel is and the very different roads you can take to get it. So I want to leave you with a question to chew on. If you were launching your absolute dream business tomorrow, debt, equity, or crowdfunding, which path will fund your future?